Stop looking at stock charts if you want to know what's going on in the stock market. I know that's counterintuitive, but I'm going to explain that today. If you see just one layer deeper than what the news is giving you and you connect the dots using the publicly available information, you're going to realize this, you're going to make better decisions, and of course, you are going to know the truth. Would you like that? Let's begin. First thing I want to show you is this. It's basically just referring to where right now at this time, the speculators, the investors are expecting the Federal Reserve, their actions to be in the near future and what they are now pricing in. The contracts show a less than 50% chance that the Federal Reserve will raise rates again this year, and cuts are expected as soon as March, around a full percentage point of cuts. So 1% are expected to be there by 2024 in that year. So this is where the money is at. This is what the big investment firms, the speculators, they're putting their money on the fact that the Federal Reserve is going to start cutting interest rates in March. And they will then do, I'm assuming at 25 basis points each, another 3 within 2024. I don't know where they get that idea, but there is just one problem with this. This whole story of the Federal Reserve cutting interest rates. Isn't it weird that the economy is going strong, that the jobs market is tight, that inflation has come down somewhat, sticky in some areas, real estate prices at or near record highs, the stock market is about to hit record highs. Everything is so fantastic. So why are you cutting interest rates? What has happened to make them think this? Well, there's more to it. Let me show you. What we're looking at is, despite the Federal Reserve and they're getting their tenacity, their decision to increase interest rates, to get real strong, to be tough, something they hadn't done in so long. Well, the actual financial conditions index has been weakening over this period. And you can see that ever since approximately October of 2022, despite the increase in the Federal Reserve's main interest rate, the Fed funds rate. And that kind of makes them look bad in a sense. But they've been trying to say, hey, everybody, investors, we're going to be tough, higher for longer, all of that. And yet the financial conditions have been weakening. What does it tell you? Well, how about this? Booming markets neutralize the impact of rate rises on U.S. corporate fundraising. Rising stocks and falling bond yields have resulted in looser financial conditions despite the Federal Reserve's tightening. It's so interesting that every investor today simply ignores what's going on. The line used to be, if you remember, don't fight the Fed. That's what they would say each and every time. Comments, I would receive dozens of comments saying this. I would see it all over, even in news articles like in Bloomberg and Reuters. Don't fight the Fed. And yet, there's a little issue with that, because that seems to have disappeared, right? As the Federal Reserve is tightening, now they're not saying that anymore. Instead, we're starting to see the market is forward looking, essentially saying, yeah, we don't want to fight the Fed. We want to just wait for the Fed to then cut interest rates, and then we'll be on our merry way. It's something real strange about this, something very uneasy, because I've studied the history, and this is something of an anomaly where there is a tightening, where we do have a slowdown, where profit margins in some cases have been squeezed. You got to look at, by the way, if you're trying to study the stock market, break it down by sector, because in some areas you may see, some incredible strength, and that throws off the whole balance. So energy was all the prices were going so wild. And now things have kind of balanced out. So make sure that you keep an eye on that when you're looking at it, whether that is the stock market index or whether you're looking at sort of profits and earnings and so on. Always make sure that you account for those anomalies or outliers. I think that is important. This is where it gets interesting though. S&P 500 profits get a lift from the crack in King Dollar's reign. Traders bet the greenback will fall more, helping overseas sales. And that's what I wanted to touch on. So here we have it, looking at the US dollar declining 10% from its peak. Okay. And when you have a strong US dollar, if you're in the US, you may not necessarily feel it as much, but somebody outside of the US, as we talked about in the mentorship program, one of the individuals from Mexico, and he specifically said how he feels it, how they can experience a US dollar exchange rate differential having an impact on so many different things. Everyday lives are disrupted by this. But if you're in the US, you may not realize this. But of course, it does have a direct impact on people and their lives, okay? And I want to break that down a little bit further right here. As speculation grows that the US central bank will halt interest rate hikes soon, traders are wagering that the dollar, which has declined over 10% from its peak in September, could lose more steam. A pullback in the greenback should, in turn, help companies that sell goods overseas and have been vulnerable to rate hikes and the ramifications of a strong greenback. You got to realize that if it is a US company, for instance, Apple, you have investments with Apple, you're thinking to purchase with Apple. Remember that while you might have the US consumer, massive purchaser of just about everything, they are also selling to just about every market in the world. So if that starts to become a problem, a real imbalance appears, well, then you've got an issue for Apple, because suddenly the buyers in, let's just say, Mexico, or maybe it's Canada or wherever, well, that's going to cost me a lot more, unless some cases when it really fluctuates that they actually change their prices. We've seen this before. But in general, if the US dollar becomes too strong, then that is something of an impact on these other countries out there. They say, well, maybe I won't go for that. And it applies to everything, not just finished products. It could be raw materials, it could be other things, because now you might have China saying, you know what, I'm not going to buy those soybeans or what have you from the US when the exchange rate is just, wow, this is crazy. I'm going to go to Brazil instead. Our exchange rate is more in line. Our currencies are not so out of whack. Do you see what I'm saying here? So it isn't all, one-sided. You've got to understand this from the company's perspectives as well. Because if you're going to go and put money into these companies, understand who their markets are. And while the US might be one of those markets, when you start to add in Europe, you start to add in parts of Asia, maybe other places, okay, I realize that, the US market, that might be 50% of it, but you start to add in all those others and it makes up that other 50, and you realize, okay, maybe a strong US dollar isn't so positive in this case. That's what I'm trying to explain here. And I just wanted to highlight that a simple change in exchange rate suddenly could boost parts of an economy or a business, or it could have the opposite effect. All depends on the circumstances. We were talking about this with the mentorship as well. And I want the people that were there that day, we were talking about I-bonds, specifically what to look at. Right now, it seems that I-bonds are no longer attractive. Why do I say that? This changes really fast. Investors yank $800 million from I-bonds as inflation slows down. One of the hottest places to store cash. The savings securities have fallen out of favor now that the yield has dipped. So it's actually not as beneficial to get it in an I-bond than it is in some basic type of accounts now. I'll show you examples. You could see on the left-hand side, that chart, that's net sales. So as the months have moved on in this year, we could see that that has diminished. Redemption, so people pulling their money out, that has been increasing. All right. So people are choosing to put their money elsewhere. Look at it. I mean, the expectation is that the I bonds would give right now 4.3%, but soon that will be less, the expectation anyway, less than 4.3%. Well, why would I do that when I could go out there, and they just give some examples right here, Goldman Sachs, Barclays, and so on, giving over 4%. And I don't have to leave it in there for a 6-month period. I could simply just pull it out whenever I want. Some high yield savings accounts. There are treasuries that you can get from Treasury Direct. You can get this as a something that's not really too difficult. Treasury Direct available to everybody in the US, and so that is something. Why would you put it into the I bonds now if they're supposedly linking it to inflation? That's coming down. You're going to get less yield. Look at where your money's at. And that's part of the fact that we are seeing less attention, less money being put into bonds right now. And stocks have been benefiting. When you see a weak currency, that could very well, in this case anyway, could help to push stock prices higher. They are sort of inversely correlated for the most part. Here we have it. Stocks crush year of the bond in the biggest sentiment shift since 1999. Fixed income overwhelms as Teflon economy strands the bears. All right. So more people putting money into stocks right now. They don't like the bonds. This is what's happening. At the same time, we watch the US dollar. This is all correlated and connected. You want to know where the money is at? You want to understand that the reality of the circumstances here is that some people have money, some businesses have money, and as we move on, the divide is becoming so much more apparent. And even those who are supposedly doing well, the honest truth is they have filled themselves up to the top with debt, and they are just hoping something changes. But their house price, a lot of these people got in at those low rates. If they did, and they're not on a variable, they're just hanging on tight as far as they can, as long as they can. But in places like Canada, in places like Australia, these things are coming due. And that, 2.5% mortgage that they had before, that's going to be a much higher circumstance. That's what the prayer is right now, that they're going to cut interest rates, or else we got a big problem. Oh yeah, or else we got a big problem. Do you see? If you are in that circumstance right there, there are many things you could do. We'll talk about that in a second. I just want to show you right here. This is a soccer player from who plays in France, I believe. But the point is, Saudi Arabia offers the guy $1.1 billion in a contract for 1 year. 1 year. I had to look it up. I had to confirm this again. I said, that's impossible. That is impossible. Turns out players get hundreds of millions of dollars. Okay. I don't know the sports world. Hundreds of millions of dollars for a soccer player, or football, depending on where you're from. That's extreme to me. But apparently this guy was going to get $1.1 billion, and he turned it down. I'm just showing you the fact that there is so much money out there, and the circumstances have changed quite a bit. There's no question. So if you want to know some of the details, some of the further details, some solutions, other things, maybe it's about real estate, maybe you want to know more of everything. Well, I've got a little bit of everything right here in the Discord. Discord is now over 800 people. We doubled the amount of people in the Discord in just a matter of weeks, it seems. If you don't know what it is, it's basically a place where we can share. I can put information in there. You can get it directly. I love it. I think it's very cool so far. And we've been conversing every single day in there. So I want you to be there as well. It's totally free, of course. Hit that link in the description, and I will see you there.